the government has created a situation where it is more profitable to be an NRI than it is to be an Indian living in India. An NRI can make an FD in dollars and get 6 and 7% tax free.
It sort of feels like now everyone's jumping onto this very trendy bandwagon of global investing, global exposure. This is the decade.
India, they don't realize this, is just 2.5% of the world market. They are putting 95% of their portfolio into not even a small cap, like a world micro cap.
You spoke about Gift City and that overall tax math just not working out. The fact that short-term tax can go as high as 40%.
If Gift City succeeds as a project, it will not only manage Indian money, tomorrow it will manage NRI money. Day after tomorrow it will manage foreigners' money.
Someone comes up to you, they say, I have 10 lakh rupees. I want to deploy this into global assets. What is it that you're going to do with that 10 lakhs?
So if I were to follow an active style, then it would be a pairing of...
One sector that's expected to benefit the most from AI.
So AI is a 5-layered cake, as Jensen Huang famously said. The last layer of it, which is a financing layer, is not known enough. There is a genuine and real fear about tech valuations. And now it's an international arms race with billions of dollars. I don't know how we can hope to compete.
A global theme that you would stay away from right now? Neil Borate has been making a compelling case for why global investing is no longer a luxury for Indian investors, but a necessity. His argument is straightforward. India represents only a small share of global market opportunities. The rupee's long-term depreciation cannot be ignored, and some of the biggest wealth creation trends of our time, particularly AI, are unfolding outside of India. At the same time, he's clear that global investing is not about blindly buying US stocks or chasing the hottest AI names. Despite allocating roughly 40% of his own portfolio to international markets, he's selectively investing in ideas such as Berkshire Hathaway and the S&P 500, as well as Brazil's EWZ ETF, rather than simply riding the AI wave. And so today in our conversation, it's very relevant. We talk about the global markets that have outperformed. We talk about some of the AI stocks like Nvidia, which have surged over 1,300% since the end of 2022, and discuss how you can really build your portfolio when it comes to global diversification. Let's get straight into it. Neil, thank you so much for joining in today. Lovely to have you with us.
Thanks for having me, Evan.
So let's get down to it, because you have said that investing in global does not equal to US tech. But a lot of people simply assume that when you say investing global, they think AI, they think US, they think tech.
Absolutely.
You want to dispel that. So tell us what you exactly mean. What should one look at then?
Absolutely. But before that, I want to take a minute to acknowledge that US tech has been a huge wealth creator. I've been an early participant in that story. We invested at a family level back in 2012. And that 5 lakhs from my dad's portfolio is now worth around 95 lakhs. Just the NASDAQ. We didn't even do anything.
When was this?
2012.
Okay.
Yeah. The compounding rate has been north of 20%, and it's been great. But there is a genuine and real fear about tech valuations. We're seeing it with the IPOs and with some of the countries that have boomed on the back of AI. So South Korea and the concentration in that market, Taiwan and TSMC. So I've been a global investor for a long time, but I have largely stepped out of tech, and my portfolio has been built around 2 pillars. One is US traditional sectors, and the other is emerging markets.
Okay.
So happy to go into both, but I want to really emphasize this, that it's not a binary choice, US tech or India. There is a third world out there from which there's a lot of money to be made.
But you keep talking about this AI-proof portfolio, right? Yeah. Do you mean a portfolio that avoids the AI hype, or one that actually survives the AI bubble bursting? What is it that you're alluding to? How do you capture the AI opportunity, or do you just steer clear?
So the answer is that I largely steer clear unless I see another great entry point into US AI. So let me go into the 2 components of the non-AI portfolio that I have. Yeah. So the first is US traditional sectors, and my largest holding there is Berkshire Hathaway. So Berkshire Hathaway is a collection of traditional businesses, insurance, railroad, uh, companies like Coca-Cola, Exxon, um, um, Amex, Bank of America, etc., which have nothing to do with AI. They do have some tech stocks. So Apple, of course, is their largest holding, but you can debate whether it's an AI stock or not. And they do have Alphabet, but again, it's not very large as a percentage of their portfolio. So companies like Berkshire help me build that non AI US holding. Another example that I have is US energy. So I've been holding on to a Vanguard ETF. The ticker is VDE, which essentially buys all the global energy behemoths: ExxonMobil, Chevron, ConocoPhillips, companies that do very well when oil spikes. And that's exactly what happened since March. Now, of course, post the war, things have normalized. It has given up some of its gains. But it has been a great hedge to all my other holdings, both global and India. So these are the two examples of my US non-tech play. And of course, emerging markets is the other one.
We'll deep dive into the portfolio in greater detail, but it sort of feels like now everyone's jumping onto this very trendy bandwagon of global investing, global exposure. This is the decade. Do you feel that to a certain extent it's just becoming a trend, or is this really here to stay? And what's your compelling argument?
So I think the main reason why anyone should go global is when they ask themselves two questions. Number one, what percentage of their portfolio is outside India currently? And number two, what percentage is India of the world market? And typically all my, whenever I talk to people, I begin with these because typically the answers you will get are about 5% outside India. It'll be through some fund or something. And India, they don't realize this, is just 2.5% of the world market. So then essentially they are putting 95% of their portfolio into not even a small cap, like a world micro cap.
Yeah. So if you want that exposure to the rest of the world, then this is the time for you to global invest. But it's complex, It takes a lot of time to understand. Like you said, it's not just AI, it's not just those stocks, it's not just the Chinese names that have caught your eye. So how do investors go about this whole process? First up, to select which countries to invest in. How does one do it?
Sure. So there are two ways to do it. One is to not select at all, in which case you just invest in the world index. That is market cap weighted. It's a passive approach. And in fact, in one of the portfolios that we offer as a company, the world index itself is a big component of it. Second level, if you do want to figure out which countries are attractively positioned, this data is available when you track the ETFs tracking these countries. So the US, being the mother market, has ETFs tracking practically every investable country in the world. So what we do at the Thefynprint is we compile a list of these major markets through the ETFs, and there you get fact sheets. What is the P ratio of this market? What are the main companies? What is the earnings growth? And you can figure it out.
Okay. So you're saying if I go for the world index, what is that giving me exposure to, and how does one go about it?
Sure. So this is the MSCI ACWI, the All Country World Index, and 65% of this is indeed the US because it's market cap weighted. So whatever's the largest takes the largest share. This is followed by developed countries, so Europe, Japan, etc. And then finally emerging markets. It's accessible through multiple ETFs. So there are ETFs in the US which track the ACWI, and there are ETFs in Europe that track the ACWI. And it's important to know this because people are also worried about US estate tax. This is a common fear I hear all the time, that after I die and if my assets in the US exceed $60,000, then US is going to impose a tax on my family. And it's a very legitimate fear, which is why the European ETFs come in.
Okay.
They're called UCITS ETFs.
Okay, so you're saying tracking ETFs is the other way to go about it, right? So say that someone says, I do want to do this on my own. I don't want to go down the world index route.
Yeah.
How do I begin? Where do I begin with this tracking of ETFs and find out a little bit more?
Yeah. So one compilation is on our website itself, on the Thefynprint.
Which website is this?
Thefynprint.com, Finprint. Where we compile about 10 major markets in the world, including the important parts of them like the P ratio, the holdings, etc.
Okay.
But that's just a starting point, honestly, because this kind of investing is for somebody who loves macroeconomics, who loves history and current affairs, what's happening in the world. So the investor will have to spend some time studying this stuff. If they don't want to, again, we have a portfolio that we can manage for them. But yeah, I mean, it takes a certain amount of research.
Okay, fair. So those are your two routes. But, I have the counter argument, Neil. The fact that everyone's saying this is India's decade right now. We have the technological leaps. We have ambitious reforms. There's so much that we're doing on the macro front as well in terms of policy frameworks. Why then shouldn't we just concentrate our portfolio to the micro market that is India?
So I think principally there are 3 issues with the India story right now. The first is that India has missed the AI revolution. And some people think that AI is just chat GPT. You can dispense with it. You can live your life with it. You did it before. Why would you not do it now? But what they don't see is what's happening under the surface. Countries are now increasingly deploying AI into factories. It's a revolution on the scale of the industrial revolution. So that's one issue. The second is that our principal driver, which was IT, is collapsing. We're seeing the stock prices, and normally stock prices collapse before the layoffs happen and the real economy damage happens. So that's the second issue. And the third is that India is not cheap. So a lot of other emerging markets have these kind of problems. They have also missed the AI bus. They also, their main sectors are threatened by something or the other, but they happen to just be extremely cheap. China 12 PE, Brazil 10 PE. We're at 20 PE still.
Okay. So there you have your very compelling argument, the 3 reasons.
And if I might just quickly add to
Please.
that. So there was a recent column by Mark Faber saying that he thinks India can go down by 20%, 20%. And I read through it, that what was his reasoning. And his main argument was exactly this. He said India is a good story, but it's just too expensive. Still, we think that after 1.5 years of stagnation, we must have gotten cheap. We've gotten cheaper, but we're still quite expensive.
As compared to the other markets out there, and the proof is in the pudding. You shared the numbers as well. Let's get to that second point, the fact that IT is collapsing. And, some would definitely agree with you saying that a lot of the giants have sort of been sleeping and not woken up in time. Is that really true? Are the larger IT players not taking cognizance of this huge AI wave?
I think they are now, but they should have done it years ago. So if you analyze what they did with their earnings, it was all given out, or not all, but a large part of it was given out as buybacks. When they could have invested that money into R&D, built their own AI strengths, just didn't happen.
So we're late to the
We're
party.
late to the party. And now it's an arms race, an international arms race with billions of dollars. I don't know how we can hope to compete.
But do you think that some of the smaller IT companies did a far better job, or is it pretty much the same case?
So the smaller IT companies are faring better, but I mean, the whole model is threatened. So relatively they might be good, but I don't know if they will compensate for what's happening in the sector.
Okay. Now let's talk about the tax implications. You brought up that US estate tax. What are the other tax, regulatory, and operational trade-offs to keep in mind when you're investing globally?
So permit me some time to go through this. There are 3 principal routes of investing overseas. So one is feeder funds, traditional mutual funds which invest overseas, and those come in 2 varieties. So either they buy another fund overseas, which makes them FOF, fund of funds. Now, these funds have all been hit by the RBI cap. So now there's only a handful of funds which are open. And if I may say so, these are basically like the last few clothes left in the shop that nobody else has wanted to buy.
Okay.
Because all the other funds were taken early, those who were performing well. So people who are still running after them take that into consideration. Many of them have very niche themes. Like there is one fund by BNP Baroda, which is an water themed fund. That can't be the core of your global allocation. The other kind of feeder fund is a fund which is an ETF listed in India, which holds stocks abroad. An ETF cannot by definition shut. So you can buy ETF units, but they trade at huge premiums, 20% kind of premium. So you're basically buying something 20% extra at extra cost, which makes no sense. The second option is Gift City. And Gift City is talked about a lot, but Gift City suffers from a series of tax problems which the government never bothered to fix. So let me get into this in a bit more detail. Gift City was designed to bring capital into India. So for an NRI, Gift City is fantastic. There is no taxation at any point in Gift or in India. But for Indians wanting to invest outside, Gift City funds don't enjoy the basic exemption that drives the mutual fund case onshore, which is that when a fund trades inside the fund, there is no taxation on you as the investor. This is how we are able to compound our money for years together without paying any tax. In gift funds,
there's no exemption.
There's no exemption. Not only that, the taxation is at fund level, which means that the short-term capital gains tax, if you and I sold a stock within 2 years, we'd pay within a year, we'd pay 20%. If you and I sold a foreign stock, let's say Apple, within 2 years, we would pay slab rate, right? Which could be 30% for us also, could be 20% for us also. But because of fund level taxation, the gift fund will pay 42.7% tax. It's insane. And the long-term taxation is also worse compared to going direct. So again, you and I would pay 12.5% after a year on Indian stocks. We would pay 12.5% after 2 years on foreign stocks or ETFs. But a gift fund would pay 14.95%. So again,
significantly higher.
And finally, just to close that point, there is no set off and carry forward. So if I make a huge gain on Nvidia, but I have a loss on Reliance Industries here, I can set them off. I can't do that in a gift fund.
Got it. Okay. So those are some of the tax issues that are very pertinent. So that's your second route of investing. What about the others?
Finally, there is the direct route, in the sense that you open a broking account, typically in the US, and you buy stocks and ETFs. Earlier, this route used to be troublesome and glitchy because of tax reasons, friction reasons, etc. Now, thankfully, it's standardized. So after 2 years, you get to pay the same long-term capital gains tax. Remittance used to be expensive. And I want to go into this in a bit more detail. So typically, when you remit money outside India, banks charge you what is called the card rate or the retail rate. And this is 2 rupees for, let's say that the dollar is rupee rate today is 95. The bank will convert your money at 97 using the card rate, especially for smaller amounts. What a lot of the platforms have done is they have bargained collectively with the banks so that that spread has come down. So with some platforms, it's 1.5 rupees above the mid-market rate. For some, it is 1. Some I have seen even 0.8, which is really bringing down that spread. So now the pipes to direct investing have gotten eased a lot.
Okay, so that is the direct route, looking at stocks and ETFs.
Correct.
Those are the three.
On the direct route, actually, I want to come onto the point of taxation and estate tax in particular. And it's really funny, a lot of Indians who I get comments from on estate tax, never make wills. Somehow in India, that's just not a priority. But my God, if the US government taxes even 1 rupee of my money and my family is affected, what do I do? So it's a very simple solve. The Europeans figured this out long before we did, because they wanted to invest in the US stocks just like we want to. So they created UCITS ETFs. These are ETFs domiciled in typically Ireland or in the Netherlands or Germany, somewhere in Europe. And they are not hit by US estate tax. The point to remember here is, even though they are domiciled in European countries, the underlying can be anywhere in the world.
Okay.
So it can be the same S&P 500, NASDAQ. It can even be a country like Brazil, which is nowhere close to Europe. These are just the centers on which these funds are created.
Okay, so those are all your tax implications, correct? And the various routes
Yes.
via which you can invest. Now, break it down for me, Neil. In terms of a typical portfolio, how much exposure should be global? Where and how should you go about it?
So the scientific answer is if you want to mirror the world index, then you should be 97% outside India. But it's not practical for any of us. So what I personally follow is the 60-40 approach. 60% in India, 40% outside. I do this mainly for two reasons. One is that even though I'm so focused on global, at heart, I do have a strong belief in India's own prospects. And I want to emphasize this because people think that sometimes I might be anti India or the Indian market. It's not true. I wouldn't otherwise have the vast majority of my portfolio here. The other reason is that many of the most successful funds we've had in India's history, to give an example, Parag Parikh FlexiCap, they have had this structure. So Parag Parikh had 35-65 until the RBI limit forced them to reduce the US allocation, which is now below 10%. So my own 60-40 is pretty close to that. And that's why I've chosen it. But it is a very personal thing. Some people have kids abroad. Some people want to eventually move abroad or have come back from abroad. So it will differ from person to person.
Okay, but you're advising a 60-40 approach. What about countries that have real issues? Certain geographies, like, for example, Russia or Sri Lanka or Turkey, they have performed quite poorly. If a country is going through those kind of issues, it does not, of course, mean that it'll necessarily stay like that forever. So what's one's approach to these geopolitical issues and countries that are particularly vulnerable to it?
Yeah, that's a fantastic question because it's a very real risk with emerging markets. So Russia actually had ETFs from the US that were investing in it. And when the war broke out, those ETFs basically went to zero. Like that money got wiped out. Another live example of a country going through huge economic damage is Indonesia. And Indonesia has no war going on, but they have a couple of issues. So their government introduced a free meal program. And we all know economics, there is no such thing as a free lunch. Nobody apparently told the government of Indonesia. So that is wrecking their fiscal situation. Apart from that, they have introduced a state monopoly for exports of natural resources. So Indonesia is very rich in palm oil and nickel, and that's nickel, for example, is important for EVs. But they decided that it has to go through a government-owned company. That is another reason for Indonesia suffering. They also have very low free float. So we often, when we think of indices, we think that passive investing, so it should be okay. But with many of the foreign indices, you have to really check for free float norms. If it's a very small amount, then those shares get manipulated. In Indonesia, they're called deep fried stocks. So just to summarize, I hold Indonesia in my portfolio. Despite all of this, I hold it because Indonesia's return over the last 16 years has been essentially negative. It's like a falling chart, and it's very, very, very cheap right now. And my hope is that some of these things turn around the country, and when they do turn around, then the upside is massive. But to cut it short, it does need a fair amount of research. What has changed though over global investing, especially macro global investing in the past, I would say year, is AI, because AI is able to, for example, every morning I tell Claude to scan the newspapers of all the countries that I invest in their local language, which would have been impossible for me.
Yeah.
Even more than a year ago. So I can do today what a hedge fund sitting in I think, or come close to a hedge fund sitting in Singapore or Hong Kong would have done.
So since you're talking about AI and all of that, but wait, I don't want to deviate. So the companies that are going through these problems, is there like a sort of a checklist that if there are inherent issues, you completely avoid? How do you know what to look at, what to scan at? What should the list typically look like to identify which countries to look at? Or just go for the world index?
So if you don't want to take all of this stress, go for the world index. But this is also fun. It's also interesting. And like I said, the research, AI has made that research very, very, very approachable, very doable. So I don't want to give a formula because my outlook is that everything has a price. Even a collapsing economy in shambles
Yes.
can sometimes overshoot
Of
on.
course. It doesn't mean that'll be the perpetual state of
Yeah,
affairs.
yeah. So I look for cheap countries. I look for countries with a P less than India typically.
Okay.
And I look for turnaround triggers. So let me give you the example of Brazil.
Okay. That's a turnaround trigger?
I think so.
Okay.
But I'll also give you the risks. So Brazil has an interest rate, a central bank interest rate of north of 14%, 14%, which is unheard of in our country, for example. And their inflation is about 4.5%, which is quite similar to ours. So the scope to cut rates in Brazil is absolutely massive. And typically, when a country starts cutting rates, the market tends to boom. So that's one trigger that I'm waiting for. Another trigger is that it's a commodity economy. So when commodities go into a super cycle, economies like Brazil tend to flourish. And I hope that will happen. The third is that it's geopolitically neutral. So unlike a Taiwan, for example, which is a flashpoint, Brazil is in a part of the world where superpowers are not exactly trying to fight it out. So there are reasons for it to really, really boom. And it's cheap. It's about 13 times price to earnings. So that's why I think it'll do well. There are some risks. Now, what is the main risk? In October, they're having a presidential election. And politics can, throw things off guard quite a bit in these countries. So that's the largest risk. The other is their government spending. That again, if that inflation goes up from 4.5%, then the rate cuts not going to happen. But Brazil is a part of my portfolio. So as long as I have enough uncorrelated emerging markets, my winners should outdo the losers.
Okay. So tell me about your portfolio. When did you start investing globally? Which are some of your largest holdings you shared with us? And roughly how much have you made over the years?
Sure. So it's been more than 10 years. And I'll be honest, my earlier track record was kind of fumbling because there was nobody in India to really tell you all this stuff. Reportage even now is next to nothing about global markets. And so in my initial years, I made a ton of mistakes and didn't really make that much money. Last couple of years have been great because a lot of these markets have boomed. So in the last year, for example, it's north of 25%. And I'm hoping that now that I've got a hang of things, my returns should also keep up with this.
What were some of the mistakes you made that maybe investors today can avoid?
Mostly behavioral. So because there's a lack of information and reinforcement, one thing to note about domestic markets is there is a lot of reinforcement on social media. If the market goes down, everyone will tweet that, look at our GDP growth, stay invested, do SIP. Sometimes they go overboard with it, but for good or for worse, that reinforcement culture is there.
So would you say ignore some of the noise?
So because for the global markets, there was no discourse at all. Sometimes when something bad would happen, I would sell too early.
Okay.
Now, thankfully, we are changing that as well. We are talking about this. But yeah, that's one mistake to really avoid.
Okay. Selling too early?
Selling too early.
Okay.
US is another great example. So S&P 500, I have bought in previous years, but after it rallied a bit, I sold too early. Had I just held it on, like we did in my dad's portfolio, it would have compounded like crazy.
So what about someone who's looking at a broad US ETF? Would that be enough for global exposure, you think?
I don't think so.
Okay.
I think countries reach certain peaks historically. So we track this chart of the world stock market, the split of the world stock market. And where the US is at right now is at a historic high. So what should happen is for the next several years is basically a power shift away from US to countries like China most likely, but also to a lesser extent, Europe, India, Japan. So the US share should go down in my view, and it makes a lot more sense to hold the rest of the world.
Let's touch upon AI because you spoke about how it's really changing the face of things. Is it just a bubble or is it the biggest investment opportunity of our time?
It is actually the biggest investment opportunity of our time, but at the right price. I have
Okay.
to underline that several times. So, which is why personally I'm not into AI much as in my portfolio, but I think that buying chance will keep coming, because technology is here to stay.
Okay. So, given that we're just about 2.5% of the overall world market, the currency as well has seen a massive dip versus the US dollar. Do you think that the debate is no longer about where Indians should invest globally, rather whether? Do you think that the debate is no longer whether Indians should invest globally, but rather why they are still structurally under allocated to global assets?
Yes, I agree with you. A lot of Indians who I speak to, and we have a large community of Indians who invest outside India, on WhatsApp, etc., is that they are waiting. Many of them for the right valuations. Many of them are taking their first baby steps, and it's new, it's unfamiliar. They're afraid to go big. But that debate has thankfully shifted, and shifted for the better. This is not a fad. This is not like crypto. It went up in 21. Now nobody's talking about it. This is a structural thing.
Okay. So, can you give me a sense, since you're so deep into this, as to what the broad perception is about global investing still in India today? And how much of the percent of Indians would you say roughly are actually investing globally quite actively?
So I have two interesting insights. Let me talk first about the percentage of Indians and the kinds of Indians who are investing globally. Which is that I used to think that if somebody has a net worth in the hundreds of crores, surely they would be diversified by now. They'd have all the advice in the world. Over the last couple of months, I've been invited to a bunch of family offices to talk about this.
Yeah.
And I was very surprised for this to happen. I thought they would already know. So that is one. So the big
So,
money,
are the Ultra-HNIs globally invested by and large?
they're not. And now they are. So that is one change that's happened in the last year. The other category of people who I expected would be globally diversified but are not are NRIs. It flabbergasted me, the number of NRIs in our community or who approach us. Many of them live in the Middle East, and
Yeah.
they're not catered to by the institutions over there. So all of their investments are in India. And when the Indian rupee takes a hit, it hurts them more than anybody else. You can't apply the argument that the spending is in rupees, so it doesn't matter.
Yeah.
So that's also changing. And this whole FCNR thing, by the way, is for them actually probably going to be a shift more into the dollar rather than less. Because what is RBI saying? Right? RBI is saying that Indian banks can offer high FCNR interest rates, which go into 6 and 7%. These are dollar deposits. A lot of NRIs so far have held on to rupee deposits, NRE deposits. They are now moving their money into FCNR, moving from rupee to dollar. The opposite of what the RBI wants to happen. So, so just to sum up the question, these are the two categories of people who are increasingly looking outside.
And what is the perception by and large when you're speaking to a lot of these investors when it comes to global investing? Do they still believe that it's not a lucrative opportunity? Do they, is there some, are there some preconceived notions that they have about global investing?
No, it's basically a tension between the structural argument, which in their head is sorted. Going global is not a choice. They want to do it. But there is a tactical problem, which is they think global equals US, global equals AI, US and AI has run up. So why do it now?
Okay.
And this forces them into a paralysis. They're like, chalo, idhar hi baiठte hain, abhi kya karu?
Okay. And that's exactly the myth that you want to bust.
Yes.
And what about those who are not doing it for tax reasons and they're worried about it? What do you want to tell them? What's your argument? There is still that perception.
There is. So I would say that the government of India has become more sensible over the years about this. It used to be quite draconian. Earlier, Black Money Act, for example, used to apply. But several years earlier, government made one important change that if you make a mistake, if you don't report money up to 20 lakhs in your ITR, 20 lakhs of foreign assets, they will not levy a penalty. So the small investor, the middle class investor, is not likely to be affected by these draconian tax rules. And over and above that, in the last budget itself, the government created a special disclosure window that as long as you've paid the tax, but you've just failed to report the assets that you've held abroad, you can just pay a 1 lakh penalty and regularize your past returns. As opposed to earlier, which was a 10 lakh penalty plus prosecution. All of that has changed quite a bit.
Okay, so you're saying that a lot of the draconian rules and policies that were in place now are gradually and have been actively being changed. You spoke about Gift City and that overall tax math just not working out. The fact that short-term tax can go as high as 40% and, long-term at about 14%. Do you think that Gift City is sort of being oversold to retail investors?
To an extent, yes. But at heart, I want Gift City to succeed because I would much rather have an Indian version of Hong Kong or Singapore where we can safely put our overseas portfolios, where we can manage our overseas portfolios and build homegrown talent. Today, all our famous fund managers are all domestic fund managers. They understand Reliance and HDFC. They don't understand or they don't study Apple, Google, or any of the European companies. That can change. We have all the talent in the world. Why should, in fact, if Gift City succeeds as a project, it will not only manage Indian money, tomorrow it will manage NRI money, the foreign money of NRIs. Day after tomorrow, it will manage foreigners' money. India will be seen as a hub for global wealth management. They have to just stop being so myopic about Gift City as only a route for entry and see it as a hub that we can build.
Okay. What about, investors who say that I'd rather, look at maybe at the LRS route, the golden visa in Dubai, getting property in Portugal and things like that for global exposure?
So LRS is the direct route and currently it is the most tax efficient route. So I would not argue with that. As far as golden visa goes, to be honest, the government has created a situation where it is more profitable to be an NRI than it is to be an Indian living in India. Even if you want to only invest in India, and here's the ironic part, an NRI can make an FD in dollars and get 6 and 7% tax free. You can go in Dubai and get that tax free. Whereas if you live in India, you have to get that money in rupees. It's a rupee FD you get. And you have to pay tax on it at 30%. Does not make sense. Same thing if you want to invest in mutual funds. If you are an NRI sitting in Dubai and you invest into a Gift City fund which feeds into Indian mutual funds, the same funds that you and I invest in, for them it's all tax free. And we have to pay tax. The government really should lighten the burden on us resident Indians who live and work here and vote for them.
So the tax burden is something that is a pain point for sure.
I mean, the market has been crying about it forever, the long-term capital gains tax. I think that, of course, needs to be worked on. But altogether, the slab rates themselves need to go up.
Okay. For an investor, if you compare ETFs, mutual funds, and the direct route, what would be the ideal and honest pecking order for Indians?
Yeah. So the direct route gives you access to ETFs, like I said, the World Index, for example. Today, in terms of choice, because if you just look at mutual funds, very little choice. Gift City, bit more choice, but not tax efficient. Here, you get the most amount of choice and you get the most sensible tax treatment. So LRS is the way to go.
Okay. And what about true diversification as you're talking about? Because beyond the S&P, it can come from small caps, mid caps across different geographies, real estate, bonds, etc. So can you tell me that looking ahead is a global portfolio less about finding the next NVIDIA and more about owning assets that actually behave differently when AI falters?
I'm so glad you asked that. Today, if you buy an Indian debt mutual fund and hold it 1 year, 2 year, 5 year, you're always going to pay slab rate taxation. If you hold a US Treasury ETF abroad after 2 years, that's 12.5%. And the US is now giving 4-5% dollars, rates that were unheard of 2-3 years ago. So absolutely, I mean, global portfolio is not just equities. You should also have bonds. You should also have commodities held through Commodity stocks, absolutely.
Okay, so if an investor already owns the S&P 500 through the SPY or the VOO, plus a little bit of NASDAQ exposure, what do you think they need to add to make that portfolio quite resilient or, appropriate according to you?
So number one would be the non-US markets, for example, China, other EMs like Brazil, Europe to an extent. And like you said, you can easily hold debt ETFs, US Treasury ETFs.
Okay. And within the other countries, are you very sector specific that, I'll look for the semiconductor opportunity in Korea, or, look at something else when it comes to Europe, etc.? Are you looking at those sectors very closely?
So I don't need to be, because many of these countries are dominated by their hero sectors already.
Correct.
So when I buy Brazil, I know I'm getting commodities.
Yes.
If I buy Korea, and by the way, I'm out of Korea, but if I did, I know I'm getting part of the AI chip ecosystem.
You've also spoken a lot about valuations and investors actually overpaying. So is the bigger risk when it comes to global investing not just what investors are buying, but the price and how expensive they're buying it? And can you just elaborate a little bit more about this?
Absolutely. Because within the range of global investing, you can get all the way from NVIDIA or any of the really, really expensive AI stocks. You can get a South Korea, for example, that's rallied probably 150% in the last year, to a beaten down Indonesia or a pretty beaten down Brazil. And I'm looking in the cheap parts of the global market.
Okay, let's get practical. If someone comes up to you, they say, I have 10 lakh rupees. I want to deploy this into global assets. What is it that you're going to do with that 10 lakhs today?
So if I were to follow an active style, then it would be a pairing of the non-AI US sectors or stocks, like I said, Berkshire Hathaway, with emerging markets that are cheap, like Brazil, Mexico, Vietnam. I haven't spoken about Vietnam, but that's another big part of my portfolio. Or if they just want to do a passive version, then buy the All Country World Index, do it gradually, do an SIP, so you don't get caught in some of the big moves.
Any risks or any disclaimers that investors need to really watch out for when they're looking at global investing?
Yeah, it's not for the faint-hearted. And you have to do a hell of a lot of research. You can't be reading only your local newspaper and be done with it.
I wish you'd started off with that. No, but good to know. And before we let you go, let's get into a quick rapid fire then, Neil, okay? US overowned or still unavoidable?
Underweighted.
Okay. Japan, Europe, or emerging markets?
Emerging markets.
Okay. One mistake new global investors always make?
They deploy money into whatever is trending, which in today's world would be AI.
Okay. One market that you think is still misunderstood globally?
China.
Okay. A global theme that you would stay away from right now?
AI.
And a global theme that you would buy on every correction?
Commodities.
IT services in India, resilient or at risk?
Very at risk. And we don't see even the trailer of it yet.
Okay. The bigger AI opportunities, software or infrastructure?
The build out is happening more in infrastructure now.
Okay. And one sector that's expected to benefit the most from AI, indirectly maybe?
So AI is a 5-layered cake, as Jensen Huang famously said. The last layer of it, which is a financing layer, is not known enough. So I think that's an interesting place.
The big beneficiary also?
The people who are financing some of the data centers and other parts of AI infrastructure, the lenders, you can say.
For a first-time investor, I know you've spoken about this, but where should global allocation begin?
With the All Country World Index, just
World
to be
Index.
familiar.
Yeah. And if markets correct, do you buy India or do you buy global or do you buy both?
I try to buy both.
Okay. Neil, it's really been very eye-opening getting your perspective. I think the fact that you highlighted that everyone is harping on the India opportunity, but it's just a micro market, means that we need to open our eyes to global investing more clearly.
Absolutely. Thank you so much, Avan.
So that was certainly an eye-opening conversation. I'm just going to recap what Neil had to say about global investing, tech, and AI. He said that US tech has certainly played a big role, but there are ways of investing in the global markets, the US traditional and the emerging markets. You can look at the world index or tracking ETFs. Remember, India only makes up 2.5% of the world markets. So Right now, you're putting your portfolio in a very concentrated space if you're only in India. We have missed the AI revolution. IT is collapsing and valuations, they sure aren't cheap. So given that the overall AI model has been threatened in India, look to invest overseas. But remember, it's not for the faint-hearted. You need to do adequate homework and you need to really do your research. Behavioral trends like making mistakes, like selling too early, all of that really needs to be avoided. You can look to have a portfolio like Neil's of 60% in India, 40% in the rest of the world. The direct route can be adopted. You can look at traditional mutual fund investing through the feeder funds, or Gift City is also an option. The World Index, as he highlighted multiple times, and of course, tracking ETFs. But do remember, it is important to really do your homework and look at the overall tax implications as well. I certainly hope you enjoyed watching this episode. Do remember to like, share, comment, and of course, tell us who you'd like to see next on the show. Thanks so much for watching. Do remember to subscribe.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.